Morning, everybody. Thanks, Adrian. Sorry about jumping in here very quickly. Adrian's got a lot of stuff he wants to go over. As he just said, yes, the FTSE has come in stronger. We were expecting FTSE to come in roughly unchanged. But what's interesting is I trade futures, and watching the futures last night, we've actually bounced 50 points off the low on the FTSE. So a lot of turmoil around, and I'm here just to explain it very briefly and let you know what's going on. Then you can focus back on the important task of trading using the charts to manage your positions, obviously. Okay, very quickly, let's just open up our calendar. I want to go on, just explain why the market shanked yesterday. We did a little bit of a piece, if any of you managed to pick it up off the website, for the Trend Signal website, just an intro to the events this week. Lot has changed since I did that piece. Really, the non-farm payroll on Good Friday was the catalyst for all this move. Basically, what's going on is you've got the US economy has been improving. China is the global growth engine, and both of those have been brought into question just of late. And certainly with the non-farm payroll on Friday, we were expecting a figure. If I could just show you what we're expecting, I can actually click on the calendar from last week. What we're looking at here, last Friday, this was when we were all either fast asleep or in church or doing whatever we did on our day off. We were expecting a figure of around 210,000. Remember, we had that ADP number on Wednesday, the previous Wednesday, which is roughly sort of 205, which is what we're expecting. But the actual number came out a lot weaker than expected. So our friend Ben Bernanke at the Fed clearly knew something that we didn't. So there's been a little bit of a re-rating, but I think this is just smoothing out gains from the first couple of months of the year. So March, a bit of a pullback, 120,000, so a lot slower than expected. I think the market has probably overreacted. But what's actually happening now is that, unfortunately, the Eurozone or the peripheral Eurozone economies are sort of a lightning rod for problems anywhere in the world. So as soon as there's an issue, there's no growth or a question mark over global growth, it immediately impacts the Eurozone economies that are struggling. The likes of Spain and Italy come to mind. In fact, Spain is the one that really hit the headlines. And that's the reason why we've seen a sharp sell-off in Eurozone stock indices. And specifically the Spanish and Italian markets were particularly weak yesterday, along with their banks. Some of the banks were, 8 to 10% off in Spain and Italy. And the reason why is that the speculation that Spain will need a bailout. Here's the headline from the FT. Spanish bailout fears hit markets. The key thing that is of interest to us is the yield on the bonds, the yield on Spanish bonds. They're saying it jumped to above 6%. They actually closed, I think, at 5.97%. Why are the yields important? What do the yields mean? For those of you who are not familiar with yields, the yield goes up when the price goes down. The cost of raising capital on the markets for the Spanish government has gone up. Why is that important? It'll cost them more money to finance their borrowings. Simply put, if you've got a mortgage at 4%, it'll be cheaper than a mortgage at 6%. The fact of the matter is Spanish bonds are reflecting the uncertainty over the Spanish economy. It's laden with debt. They've got an austerity budget in place for the new government, and it was described today on one of the commentators on Wake Up to Money this morning at 5:30. Spain it's attempting a budget which is like sort of trying to help the economy. It's similar to sort of sitting in a chair and trying to lift it at the same time. The fact of the matter is the austerity measures will dampen down significantly economic activity at a time when really the economy needs to improve. But you know what? That's what happens. As an individual, if you go into debt, you've got to pay that debt off and live at the same time. It's a tough equation to square, really. So the big issues were, with the Spanish bailout. Is that going to happen? I don't think it will. I think Spain is a totally different animal to Greece. But golly, the speculation just builds. As I say, any problems anywhere in the world, This was precipitated by the non-farm payroll in the States on Friday. We saw some big moves, not just in Eurozone indices, but also the US. I think it's probably a little bit overblown, but it just goes to show you how vulnerable these economies are, the peripheral Eurozone economies. And actually, it's amazing, just listening to Adrian, that the euro has steadied up the way it has done. But you've got to remember that there are some very strong economies, specifically Germany in the Eurozone. And there are quite a lot of demand for euros due to Germany's efforts in the equation. So it's not quite so obviously a short, but you can't help think that we're going to try and challenge that 130.50 level again on dollar-euro. Looking at the daily charts, I know this is a 15-minute chart, but if I quickly put up a daily chart to remind everyone, let's just compress this. That's the FTSE. I wanted to put up dollar-euro. That's the next cleverest thing. Okay, here's dollar-euro. So really, it's this 130. 130.50 level. This is where we expect the market to sort of try and challenge again. But it's certainly trading in a quite a sort of narrow range, as you can see here on the daily chart. But you can imagine if that breaks, we have quite a move potentially down to the sort of lows from early on this year when it hit the sort of 126.5 level. Other than that, let's go back to the data. Okay, the calendar here. I spoke to, we put out a little report yesterday. There's not a lot of data out this week. You can see, everyone, by looking at the calendar, there are very few red high-impact bits of information here. There's nothing really too much to go on about. Today we've got the beige book. If you remember, we had that last month that sort of slightly upset the markets because it implied that perhaps there may not be any quantitative easing. Isn't it funny? The market wants this drug, wants this extra liquidity, the long-term refinancing operation that the ECB did, quantitative easing that the US and the UK central banks have done. It's like a drug. If there's no more supply of it, the market gets really, really worried. And yet, really, it shouldn't be provided until the market's really needed. You don't give it to the market when it's on a high, and yet the market's come off because it's worried it's not going to get any more. Yeah, very much like a drug, isn't it, really? Yeah. So the beige book at 7 o'clock tonight, you shouldn't be trading then anyway. And if you are, please watch out for that because it can upset the apple cart a little bit. For those of you trading crude oil, we've got the crude oil inventories at 3.30. Still a big worry, crude. Still particularly high price, bearing in mind the sort of potential setbacks that are befalling more recently the US and the Eurozone. So that is a little bit of a worry. So we always watch the oil price, and the inventories do have an impact on the oil price, obviously. So 3.30 if you're a crude oil trader. Other than that, we've got trade balance in the US tomorrow. This is the balance of trade with imports versus export. That's goods and services. Typically, as the economy picks up, you'd expect the trade balance, the deficit, to increase. We're targeting a figure of minus 51.9 billion. Basically, as consumer sentiment improves, consumer credit's increased, American consumer is spending more, and typically they spend more. The imports go up more than exports increase, so you'd expect to see that trade balance increase. And of course, following on from Friday's non-farm payroll, we've got the weekly claims. That's always of interest to us, but it's a weekly piece of data. It's the monthly data that we're most interested in, but that can have an effect, but they tend to be pretty accurate, really, so that we're not expecting any shakes there. Other than that, it's China. We mentioned the US as a key linchpin in the global economy that has been doing rather well. Obviously, the setback in non-farm payroll won't be good reading for President Barack Obama as he enters this election year and presidential elections in November. So he's got that to worry about. But US unemployment actually has done very well. Since August last year, we've fallen from 9.2 or 9.3 to 8.2. So it's been a significant fall, really. But, the election will precipitate few concerns over what's going on in that. But I do think unemployment, this particular number was just a smoothing out exercise, really, and I don't think that we're going to see any significant slowdown in employment in the States. So other than that, as I said, it's China, and there's a lot of information out from China on Friday morning. The reason why I'm mentioning this is because you're going to wake up on Friday morning. This data comes out early doors around 3 o'clock in the morning. Industrial production is a key bit of data in China. Mad numbers, I know, it's something that we're not used to, but that number, 11.5%, if we don't see a strong number, and remember we do need to see China has to have a very strong growth to maintain its economy. If it starts to set back, it has all sorts of implications. So it's important that it maintains its growth. If you see that industrial production number short, it could obviously precipitate talk of further interest rate cuts in China, and also it would be quite bearish, obviously, for the resource sector, for the Aussie dollar, Canada dollar. So if you're trading any mining stocks, etc., that could have an impact. And there's also the GDP number in China. If you note, recently the Chinese authorities have talked about lowering their target from 8% to an annual growth target of 7.5%. Having targeted 8% for 6 years, and I think that spooked the market when they made that announcement. So it'd be quite interesting to see where this GDP number comes in. Still a healthy number of 8.4%. That's it for the week. A lot going on. US data again in the afternoon, but I think that the Chinese news is probably the most important. But we do have CPI in the States at 1:30, and then the University of Michigan Consumer Sentiment at 2 to 3. That's all the data. That's all the news. Good luck with the markets. Pass you back to Adrian.